Well, welcome everyone to our next session. I'm very excited to introduce our next presenter to the stage. Zach Haptonstall is the Chief Executive Officer and co-founder of Rise48 Equity and Rise48 Communities. His main responsibilities as CEO include overseeing all acquisitions, sourcing capital, and building strategic partnerships. Zach, it's an absolute pleasure to welcome you back to the Money Show stage. We're ready when you are.
Yeah, no, thanks so much, Jordan. And thanks for everybody for making the time. Thank you to Money Show for having us on the platform here and really appreciate your time. And so, yeah, like Jordan said, my name is Zach Haptonstall. I'm the CEO and co-founder of Rise48 Equity. And we've purchased, over $1.5 billion worth of assets since 2019, all here in the Phoenix Metro. We've gone full cycle and sold 11 different properties. We've had over 4,000 different individuals. We now have nearly 200 plus, full-time W-2 employees, and we all just kind of started from scratch. And so kind of tell our story of how we kind of scaled the business, built it out, and then kind of tell a little bit about our company, our approach, our business plan, and what we're seeing in the market. And so, probably like many investments that, many of you investors see, our minimum investment is $50K per investor per deal. We typically have anywhere between 100 to 500 individual investors in each deal, just depending on the size of it. Most people are coming in somewhere between 50 to 200K. Some people do larger amounts. That's what we see most commonly. Like I said, we've had over 4,000 different individuals invest with us now so far. And we have many of our investors are investing in multiple deals. We also have several first-time investors in every deal because we're constantly receiving referrals or, people are finding us online, things like that. But in regards to us at Rise48 Equity, and I've got a presentation here today. I'll probably skip around through the presentation because I kind of want to just have like an organic flow of telling you about the company. And so the order of the slides may not match up. So I might go forward and backward a little bit. But in regards to the company, there's three of us who started the company. We all met in early 2018, have been working together ever since then. Okay, so it's Bikran Sandhu, Robert Szewczyk, and myself. Bikran is our CFO. So he has an economics degree, CPA, worked at PricewaterhouseCoopers for a number of years as a corporate auditor. So very strong financial analysis background. He's doing all the underwriting on the front end for these deals, as well as overseeing all the financial analysis post-acquisition, just making sure operations are staying on budget. Robert is our chief construction officer. So he has a master's degree in architecture, strong construction background. He's overseeing all the large capital item projects, as well as the interior renovation, just making sure those are staying on schedule and on budget. And then myself, I'm overseeing acquisitions, dispositions, sourcing capital, forming partnerships. I was born and raised here in Phoenix, so lived here my entire life. I actually have a journalism degree, so I was a live news anchor and sports reporter for Arizona PBS for a short time, which was cool at first. And then I quickly realized you can't make any money in journalism. And I had all this student debt. And so it's like, man, I need to make money. So I got out of journalism. And of all things, I went into healthcare marketing, kind of an odd job, working for a hospice organization. Okay. So my job was to wake up in the morning, drive around Phoenix and just cold call, walking into hospitals, doctors' offices, assisted livings, and build relationships like physicians, nurses, social workers. When they had somebody who needed hospice care, I would meet with the family, educate them, get them signed up, and their Medicare would pay for that. And so anyways, long story short, I was a marketer, then a director of marketing, and then became president and co-owner of a large hospice organization here in Phoenix. We had about 110 employees, got my MBA, and was fortunate to do well in healthcare, but ultimately just got burnt out that industry. Okay. So in January of 2018, so about 5 years ago to this month, I resigned, sold my equity in that company, and lived off of savings for well over a year to figure out how to get into multifamily. That's when I met these two guys. We partnered up. We bought our first property together. It was a 36 unit, $3.5 million deal. And it was just the three of us and a couple other people. Okay. So we had no passive investors. We all just put in big chunks of our own money, because we really wanted to learn how to execute a value add plan firsthand and really get, nitty gritty into the details of asset management and day-to-day operations. That's what we did. And that was really good to give us the experience and momentum to then go forward and start syndicating these deals and raising money from passive investors. And so since then, we've purchased 38 different properties, over $1.5 billion worth of assets. We need to update this slide a little bit. In over 6,500 units, all here in the Phoenix Metro. Every single deal we've acquired has drastically exceeded projections. We do monthly distributions and monthly reporting. Here you can kind of see a map of our portfolio in the Phoenix market and kind of give everybody an idea on track record. So we've now successfully executed the business plan, gone full cycle, and sold 11 different properties. Okay, so we've sold one since we updated the slide. So 11 different investments we've executed the plan and sold. Here you can kind of see the average returns. Okay, and so across those 11 deals, we've been averaging to double investor money in about 18 months on average. Average internal rate of return, or IRR, to the LP has been about 70%. And obviously the market was strong, but we've really demonstrated an ability to execute a business plan by renovating units quickly and efficiently and staying on schedule and on budget. And I'll go into our operations here shortly in our supply chain to kind of tell you how we've done that. And we're telling investors that even with interest rates going up, and these have always been a 5-year projection. Okay, so we've never projected an 18-month hold period. And I'll kind of go into the projected returns and the structure here shortly. But even right now, we feel very confident we can not only hit our 5-year projections, but potentially still be getting these strong returns in 3 to 4 years. As interest rates have gone up, organic rent growth has started to really decelerate across the country. And so I'll kind of go more into that here shortly. But in regards to the team and the operations, so like I mentioned, there's 3 of us who started the company. And, all 3 of us have quit any other W-2 job or business that we're associated with. Okay, so we're all 100% focused on this. We're all local here in Phoenix. We have a business office here in North Scottsdale area that we own, which is where I am right now. And so we're all here every day along with our staff, Monday through Friday, 50, 60 hours a week. In addition to the equity company, we are completely vertically integrated with our own property management company. Okay, and so we do all of our own property management in-house. You can kind of see a little bit of an org chart here, and just kind of gives you an idea, of the structure. And so we do all of our own property management. We don't do any third-party property management. So we're only managing our own portfolio. In the Phoenix market, we now have well over 170 plus full-time W-2 salaried employees across the equity company and the property management company. And so all of the on-site maintenance, leasing managers, all of our staff, which has really been good to give us a lot of efficiencies to really, crank through these business plans ahead of schedule and generate those higher velocity returns. In addition to being local and having the full team, one of our biggest advantages, and the reason we've been able to scale rather quickly in this market, is our relationships with local real estate brokers. Okay, so the majority of our acquisitions now have been sourced completely off market, with no competition from anybody else, just directly through these broker relationships. And so that allows us to source the deal at a good basis that makes sense without getting bid up in a competitive environment. And then in reality, we've been executing our business plans faster and more efficiently than what we project in the model. Okay, and I'll kind of go into the business plan here shortly. And then, being in a market as strong as Phoenix, probably one of the strongest markets fundamentally, for multifamily in the country. So all these factors combined have really accelerated these timelines, so where we've been hitting our 5-year projections, within a couple of years, and generating those high velocity returns for our investors. And so here you kind of see, some of our leadership team. The key player to everything, really the glue to the company, is really our Chief Happiness Officer here, Bentley. He really is critical to the company. And here you see some of our leadership staff as well. And so we've built out, this vertically integrated company. And our business plan is probably pretty similar to what a lot of investors are familiar with. Okay, we consider ourselves light value add operators. Okay, I think that we probably do a deeper interior scope than most operators. We're probably more hands-on with operations than most sponsors. But we're looking for B-class assets in A and B locations. Okay, so primarily 1980s vintage properties, at least 100 plus units. This is workforce housing demographic. So clean, safe communities where the majority of the population lives. And when we buy these deals, are typically always at least minimum 85 to 100% physically occupied when we buy them. Okay, so they're almost completely full or are completely full, cash flowing day one, providing cash flow to investors immediately. And for every single deal, we'll go in there on the exterior and completely rebrand the asset. Okay, so we rename it, we do a new monument sign with an LED backlight, which just helps the curb appeal, leasing activity, new marketing banners, landscaping, 3-tone exterior paint. We add amenities like a fitness center, a dog park, a playground. And then on the interiors, we don't build any new structures, and we don't change floor plans. Okay, so we don't buy lumber or any of these materials that have been subject to heavy inflation. And we actually have not had any major inflation or supply chain issues that have impacted any of our properties in all of 2021 or 2022. And I'll kind of go into our supply chain here shortly. But on the interiors, we do a full interior renovation scope. Okay, so we do brand new gray vinyl plank flooring. We do a real quartz countertop with undermount sinks, modern plumbing pull-down fixtures, subway tile backsplash, stainless steel appliances, brand new cabinet boxes with shaker doors and brush nickel hardware, two-tone paint, LED lighting package, and new baseboard. So it's a full interior scope. And by the time we're done, it looks like a Class A luxury interior finish, but it's in a workforce housing type of product, which is still affordable and where the majority of the population lives. That allows us to drastically increase the rents, which increases the value of the property and gets us that profit margin for the investors. And, I mentioned we do all the property management in-house. Well, we also do all the construction management in-house. Okay, so between our VP of operations, Kaylee here, our construction manager, Dallas, and their respective staffs, we personally source, bid out, and manage all of our own vendors and construction crews. Okay, so all the roofers, plumbers, electricians, general contractors, we're bidding these guys out and then managing them daily on site with our staff. And so Dallas here, our construction manager, he has 4 construction coordinators who report to him, and all 5 of them are full-time W-2 salaried staff. And all 5 of them each literally spend 40 plus hours a week just walking units that are undergoing renovations, making sure they're staying on schedule and on budget. In addition to that, we personally source and purchase all of our own materials directly wholesale from an overseas manufacturer. Okay, so we have no middleman. We're buying everything in bulk, everything wholesale. So pretty much every single thing inside that unit, with the exception of the adhesive for the vinyl plank flooring, and then the appliance, we use a third party. Okay, so basically all of our flooring, countertops, cabinets, everything, we're buying it all directly wholesale, direct from the manufacturer. We have it shipped to, and by the way, we've recently expanded to Dallas. Okay, so we have the same manufacturer, same supply chain in both markets. And so we've got offices in both markets now as well, which I can kind of go into if we have time. But they're basically ship those materials to our warehouses in Phoenix and Dallas, and then have it shipped and dropped right inside the unit, where basically there will be 2 pallets in that unit that has every single thing that unit needs custom measured. Okay, the custom flooring, the countertops have already been prefabricated, quartz, all the cabinets assembled. And so, we truly have 100% control. And so we require that all of our construction crews use our materials so that we truly control the supply chain, and they can't, increase cost on us and blame it on inflation or anything like that. And so that's given us a lot of control and efficiencies to really crank through these renovations. And just in the last 24 months alone, we've renovated well over 1,000 plus units. Okay, the interiors, all the same scope, same materials, everything. And every single unit we've renovated the last 2 years has met or exceeded our projected rent. Every single one. Okay. And so, that just shows you kind of the efficiencies we've been able to generate and kind of stamp out this business plan. So, and that gives you some insight into the team and the operations. And, in regards to kind of like the projected returns and the structure, kind of give investors an idea of how we do this. Like I mentioned, in reality, we've sold 11 deals, and we've averaged a double investor money in just about a year and a half, but we of course don't project that. Okay. And so we have a very conservative 5-year underwriting model with a stress test built in there, which assumes that right after we buy the deal, and we've been doing this since we started, right after we buy the deal, there will immediately be some type of significant economic downturn or recession that hits, where the organic rent growth in the market will just plummet immediately and decrease significantly and stay there for 5 consecutive years. Vacancy will increase immediately, stay there for 5 consecutive years. And that even with that downturn, we can hold through the recession, execute the business plan, and sell in year 5 to achieve the returns we're projecting to investors. And so, over this risk-adjusted 5-year projection, like if we were to show an investor a new investment opportunity, we're typically projecting to achieve between like a 1.9 to 2x equity multiple over 5 years. So typically projecting to double investors' money over 5 years. Typically 6 to 7% average cash flow over the 5 years, typically 14 to 16% internal rate of return, or IRR, over the 5 years, and then typically 18 to 20% total average annual return per year over the 5 years. So that's from the conservative risk-adjusted projection. And like we said, fortunately, we've been kind of blowing those numbers out of the water in less than half the time, but that's what we project. And then as an investor, we have a few different investor classes. Okay, so we have really what's called our high cash flow class, Class A. which is really for investors who want higher immediate cash flow during the investment, but will not participate in upside. Okay, so it's a $50,000 minimum investment. You get a 10% preferred cash on cash. You're gonna get 10% cash flow on your money starting out immediately in year one. So if you invest 100K, you get $10,000 a year paid out in equal monthly installments. Once we sell the deal, you'll get your initial investment back. Okay, and there's no upside. So this is for more conservative investors. We have our class B, which is our growth class. This is probably 80 to 85% of our investors do this class, and this is a $50,000 minimum investment. You have a 7% preferred cash on cash return. So it's a 100-0 split between the passive investor and us, the sponsor, until your preferred return is caught up. Okay, so 100% of cash flow, 100% of equity goes to passive investors. We, the sponsor, receive 0 cash flow, 0 equity until your preferred return is caught up. Okay, so for example, typically in these deals, the cash flow in year one starts out between 4 to 5%. Okay, because these are value add deals. We're renovating units, increasing the rents, and then it starts to trend up quickly years 2, 3, 4 to get you to an average of 6 to 7% over the 5 years. But if you have a preferred return of 7% and in year one, I give you 4%, well, then in year two, I owe you 3% from year one, plus another 7% for year two. And that just continues to accrue. Okay, so until we catch you up on that, it's a 100-0 split. And we tell investors that we, as the sponsor, we're really not going to receive any cash flow or quote unquote sweat equity in the deal until we've actually executed the business plan and achieved a capital event like a sale or a refinance. At that point, we can fully catch you up on your preferred return. After we've caught you up on your preferred return, it's a 70-30 split. 70% goes to the passive investor, 30% goes to us, the sponsor. Then we have a second hurdle in here, which is if we hit a 2x equity multiple to the passive investor after everything. So if we've doubled investor money, any proceeds over that, if there are any additional proceeds, we split 50-50. And the thinking there is we've exceeded the expectation, split the upside accordingly. So class B is that 7% preferred return, 70-30 over that, 50-50, anything over a 2x. We also have what's called a class C, which is a $500,000 minimum investment. It's a preferential return structure for a larger investment amount. Okay, so it's 500K instead of 50K. You get an 8% preferred cash on cash instead of a 7. And then we do an 80-20 split instead of a 70-30. So 80 to the passive investor, 20 to us. And there is no second hurdle over a 2x multiple. It's just 80-20 regardless of the upside. And so, for class C, we've had individuals that will invest through class C. We also have groups of people, so if there's 5 colleagues that want to do 100K each, and they say, hey, we're together as a group, we can give each of them individually the class C structure. They don't need to put it all together in one LLC that way, because that way it just allows us to get bigger chunks of equity. And so that kind of gives you some insight into the projected returns and the structure. And then in regards to investor communication and distributions, so if you were to invest with us, then we'll give you login credentials to our investor portal, which you can access 24/7. You have 100% visibility into all the financials, the operating statements. We even upload the general ledger in there. And so everything that we have visibility to, you have visibility to, and you can always access that at any point. And then we're going to upload all of your fully executed subscription documents in that portal. So you can always download that. We do a full cost segregation study on every single deal to take full advantage of depreciation benefits. Okay, so if you're a real estate professional, you can reap the benefits of bonus depreciation. Even if you're not, you can get the benefits of the passive losses. Okay, and I'll give the disclaimer, I'm not a CPA, so consult your CPA, but I can say that we've never heard of any investor, whether they're a real estate professional or not, having to pay taxes on their passive income, because those passive losses show that you took a loss, even though you're getting distributions every month throughout the year, and really, makes that passive income completely untaxed. Okay, that's what we've seen. So we're going to upload your K1 into your portal every year, right around tax season. So you can download that, give that to your CPA. In regards to investor communication, we do monthly distributions. We do monthly investor reporting. And so the last week of every month, you'll receive a full report on your previous month's performance. Okay, so it's going to show you, here's the progress in the large capital item projects. Here's the progress on the interior renovations. Here's where net operating income and expenses came in for this particular month versus where we had projected to be for that particular month before the project. So every single month you get this full report, which just shows you here's how we're performing at this point in time versus where we had projected to be performing at this point in time. And you always have that context. And so that's the monthly reporting. And then, excuse me, in regards to distributions, we do monthly cash flow distributions. Excuse me, one sec. Sorry, I've got some allergies here. One sec. All right, I'm back. Sorry about that. I got some allergies here and just kind of caught my throat there. But anyways, so in regards to distributions, we do monthly cash flow distributions. And so we always tell investors that we're going to start those monthly distributions 90 days after closing. That's just to ensure we have a smooth takeover and start executing the business plan. And so, you are earning those distributions immediately after closing, and those are accruing. And so 90 days after closing, we'll pay out that first distribution, which is a culmination of the first 3 months, all paid out in one. After that first distribution, you can expect to receive a direct deposit hit your account the first week of every single month going forward throughout the duration of the investment period. Okay, so you get monthly distributions, monthly reporting, and that's kind of what the distributions and reporting looks like. And so that pretty much gives you an overview, of the company, the organization, kind of, what we've built, and how we've been able to scale the business. And I mentioned that we've done everything in the Phoenix market. Well, just in December of 2022, we opened a Dallas office. So we have a 9,000 square foot office in downtown Dallas. Excuse me. And we'll have the exact same model there. So my wife and I actually just bought a second home in Dallas, so we can be there every couple of weeks for operations meetings. We have staff there, and we've actually got a couple of deals under contract right now. So the plan in 2023 is to be equally balanced in Phoenix and Dallas, provide the diversification for investors. And we actually are going to be launching a 506c fund here at the end of January. So if you're interested in learning about these types of opportunities, then make sure you click the button to show you're interested. We can put you on our list to potentially invest in our fund, which will give you diversification. So with that, I know we got about like 5 minutes, Jordan. Before I my throat here, I'll take maybe if anybody has questions, we can do like a Q&A.
Yeah, we got a lot of questions. So we've got
go ahead.
Okay, we've got about 8 minutes, so let's see how many we can get through. Where is Phoenix on the drought? Is there any issues you see there with the water issues?
Yeah, great question. And we actually have it's not in this deck, but we do have like an Arizona water facts slide that I can send people. So obviously that's been a big story. I'm a part of what's called GPEC, the Greater Phoenix Economic Council, which is the #1 economic development organization, for Arizona. And so they're the ones that are working directly with like Taiwan Semiconductor, the big microchip manufacturing company, and bringing these huge companies in. And pretty much every council member and mayor in Arizona and the governor are part of this. And so we get a lot of information. And so there's something called the Arizona 1980 Groundwater Act, which Arizona has required to have a 100-year of groundwater water supply at all times. And so, yes, the Colorado River is coming down. Arizona, it's about 30% of their water from the Colorado River. Okay, we have over 100-year water supply just stashed away in groundwater. I've lived in Phoenix my entire life, infill Phoenix, born and raised. I can honestly tell you, I've never once personally heard locally from anybody I know of having any issues with water. Arizona has never had any planned municipal or residential restriction or stoppage of water, like California has and things like that. And so I can tell you that the majority of water usage because we've done these studies and I've talked to the utility companies as part of being GPEC, the majority of the water usage is agricultural usage, okay, which is in the far southwest, far southeast metro. Okay, this is like 40, 50 miles away from infill Phoenix metro or more. Okay, and so you're talking about Goodyear, Avondale, Buckeye in the southwest. You're talking about Santan Valley, Queen Creek in the southeast. And what's been happening is that a lot of that land the last 5 to 10 years is getting bought up and converted into industrial and manufacturing and using significantly less water. And so, yes, the water in the Colorado River is down, no doubt. But, and we get this question all the time from investors, but we're an infill Phoenix where they planned out and built out the infrastructure. I think they didn't plan as much for Phoenix to grow so far out because we're not landlocked. And so I think that right now, there's been no immediate issues that we're aware of, okay, that we see, and it shouldn't impact any of our properties. And we have a 100-year water supply. But I think the more tertiary areas farther out would be the impacted, if it did happen.
Excellent. Thank you very much. Let's jump to our next question here. How do you differentiate yourself from other passive income real estate syndicate firms that have present here on this forum? Not that you perhaps know all the people that have presented, but perhaps you can just tell us what makes you guys truly unique.
Yeah. So we know, we're on lists of most of these syndicator forums and our syndicator groups. And so I think that, people who are familiar with most of these groups is the majority of groups that you look at, they don't even buy deals in the same market that they live in. Most people are buying deals in a different market. They don't even live there. And even fewer are completely vertically integrated with their own property management company. The majority of companies are using third-party management in a different market. Okay. And I'm not saying it can't work, but it's very difficult to be proficient with operations. The last 5 to 7 years, pretty much anybody in the country could buy a deal and you're going to have organic rent growth, cap rate compression, and you're going to look like a genius. And nobody actually had to execute a value add plan because the values just go up by themselves. And you didn't have to do anything. And we've been benefactors of that too, no doubt. But like I said, we've truly built out infrastructure and demonstrated that we can crank through a business plan and renovate a unit and force the appreciation. We don't have to rely on organic appreciation. Going forward, the next 3 to 5 years, especially, the superior operators who have control over their operations, their on-site management, and can truly execute a plan and what I mean by that is renovating units on schedule, on budget to hit your pro forma rents. They are completely separate themselves because the strong market has covered a lot of blemishes for a lot of people the last several years. So the fact that, we're vertically integrated, we're local, we have a fully built out team. Like this office that we have is 21,000 square feet, and we bought the building. We own the building because we were sick of outgrowing our leases, dealing with the landlord. We have a full investor relations staff, so investors can call at any time, get answers to their questions. We have 15 full-time W-2 salaried employees in our accounting department. We hit those monthly distributions. So we're fully integrated, and we're doing the same model in Dallas. Okay. So we're vertically integrated in Dallas. We've already hired 15 full-time people there. And to show our commitment, we don't ever want to be one of those sponsors that seems negligent living out of state. So we literally my wife and I just bought a house in Dallas because Bikran and I, our CFO, we're going to be there every 2 weeks for our biweekly operations meetings with our leadership team there, just like we do in Phoenix. And so I think the way we separate ourselves is that we're running this company like a true institutional type of company, but we're offering opportunities to retail investors. And to give people an idea, we're the #1 buyer of apartments in Arizona over the last year. We're #3 the last 5 years. We're right there with Goldman Sachs, Blackstone, life insurance companies. So there is no syndication group that has scaled as quickly as us, I think, in the country, but especially not as big in Phoenix and in this market. And we've gone full cycle. We've sold 11 deals. Most sponsors have not gone full cycle on even 1 or 2 deals. And so we've proven that out. Then one thing I'll add is that we like to use we like to utilize the 1031 exchange. Most sponsors don't do that because it's very complex. Of the 11 deals we've sold, we've done 7 1031 exchanges, meaning that as an investor, you have the option to participate in the exchange, defer your capital gains tax upon a sale. So anyways, those are some quick bullet points.
Okay, I think we've got time for maybe one more question. Do you plan to buy properties in Texas? How about the Southeast US?
Yeah, good question. Yeah, so we're actively expanding to Dallas. We have about 700 units under contract right now. We're closing our first one in 2 weeks. We're going to close the next one in March, and I'm pretty sure we just won a third one today. I sent an offer right before this call, and so our goal is to buy 3,000 units in Dallas this year. I think we'll probably be a top 5 buyer in Dallas this year. As I mentioned earlier, the broker relationships that we have in Phoenix give people an idea. In all the big markets in the country, Phoenix, Dallas, some of those Florida markets, the Carolinas, there's like 5 to 7 brokers, 5 to 7 individuals who control like 90% of the inventory. In Phoenix, I know all of them well. I lead the acquisitions, and we've done multiple deals with all of them. Most of them are off market. They give us the first look. It's the same national brokerage firms in Dallas as it is in Phoenix. CBRE, Marcus & Millichap, Berkadia, Northmark, JLL. They referred us, my guys here in Phoenix referred us to all of their top guys in Dallas And in November, we went out there and met with all the top guys in person, every single one. They're just feeding us deal flow because they know that we can close. We're 38 for 38. We've never dropped a deal. We've never not been able to raise the money. And so, yeah, we're going to expand in Dallas, and we want to be equally balanced in Phoenix and Dallas this year. If this goes well, potentially 2024, 2025, we may look at expanding to some of those Florida markets. We want to be in those top Sunbelt markets. We've had and I'll wrap it up here, Jordan. We've had enough equity demand to go to another market for over 2 years now. I mean, just last year, we bought $870 million worth of assets, and we raised $340 million of cash equity from investors. We've been waiting to truly build out our infrastructure and our back office to feel like we can responsibly expand and replicate that in the market. And now we're at that point. Beginning of 2022, we were saying in 2023, we're going to go to Vegas because Vegas was similar to Phoenix. Once, second quarter came, interest rates go up, recession starts to kick in. We decided, you know what, we don't want to touch Vegas. We think it's going to get crushed. We don't think their employment base is diversified enough. So we really like Dallas. We think Phoenix and Dallas are very well insulated. Phoenix had the lowest job loss rate in the entire country during COVID. People are probably seeing organic rent growth in Phoenix is decelerating quickly. Well, it also went up faster than anywhere in the country the last 3 years, 30 to 40% total. So it has a higher basis. And so, we still really like the fundamentals. We have over 5,000 units in Phoenix, and we're having no issues exceeding our pro forma rents right now. Okay. So anyways, yeah, we'll be in Dallas and Phoenix and maybe other markets in the future. And then if anybody else has any questions, you can email me, zach@rise48equity.com, zach@rise48equity.com. If you're interested in being on our list for this 506c fund, please indicate that with Money Show and reach out to us, and we can send that to you here in a few weeks.
Excellent, Zach. Fantastic presentation. For more details, you can go ahead and refresh the page or just scroll down and directly reach out to Zach and his team through the virtual booth. We thank you for your time, Zach, and for being a valued Money Show partner.
Thanks, everybody. Thanks, Jordan. Appreciate it, guys. Have a good day.
All right, thanks so much.